Hello everyone, and welcome to episode 2.3 in the Investing for Beginners course. Today, we're going to take a break from the conceptual terminology and take a step into the mathematical world of investing. We're going to learn many of the ratios and formulas that investors use to get an idea of how financially sound a company is or how much it can grow over the next few years. Let's get started. There are four main types of financial ratios: liquidity, efficiency, leverage, and profitability ratios. Each one is quite self-explanatory, because it's pretty obvious that profitability ratios are ratios that tell investors how profitable a company is, efficiency ratios tell you how efficient a company is at selling products, and so on. Each ratio that we'll learn today are simply combinations of the terms that we learned in previous episodes on balance sheets. In the next few slides, we'll see the various ratios, their formulas, and what they measure. However, I'll leave the actual application for a later unit. One final piece of advice before we begin. It's a good idea to take some notes about each ratio that we'll go over today, because they're going to be hugely important in the coming videos. Having a reference sheet somewhere, on paper or on a computer, is a good choice. There are over 30 ratios that we'll go over today, so let's jump straight into liquidity ratios. We'll start with the current ratio, one of the most popular liquidity ratios used by investors. As we saw in the previous video, current only signifies that the asset or liability was created in the past 12 months. The current ratio just compares assets to liabilities to see which of the two the company has more of. Naturally, we want more assets than liabilities, so the ideal current ratio is large. The quick ratio is similar to the current ratio in terms of what it measures. However, the quick ratio focuses on assets that can be turned into solid cash quickly, like any type of investment that the company might have, cash, or cash equivalents. That's why we just take the unsold inventories out of the equation, because they can't be turned into cash very quickly. Again, we want the quick ratio to be high. On this list, there are a few ratios that can be put into several different sections. The cash conversion cycle is one of those ratios, because it can go into the liquidity as well as efficiency ratios. The cash conversion cycle, or CCC, measures how fast the company can turn resources into money. Naturally, you would want a company to be pretty efficient at doing this, so the resulting number should be low. The cash generating power, I think, is quite self-explanatory, as the name says it all. This is a measure of how much cash a company can generate from operations. Obviously, this should be high. Book value per share is an important one. The book value would tell you how much each share would be worth if the company was dissolved today. If the book value is higher than the current stock price, then that might indicate that the company is undervalued and a good time to buy. Conversely, if the book value is lower than the current stock price, that might indicate that the company is overvalued and in danger of falling. Our final liquidity ratio is the price to book ratio. This is just an extension of the book value per share, and it tells you exactly what I said in the previous slide. Just one thing to add. While the book value generally should be lower than the stock price, that could also mean that there is something fundamentally wrong with the company. So make sure you do additional research apart from simply calculating the book value, because it's not always super reliable. Now, let's make the transition to profitability ratios. The first one we'll look at is earnings per share, more commonly known as EPS. It's one of the most popular ratios in the investing world because of its simplicity. Basically, it just looks at the total profit of a company and checks out how much of that profit is going to each share. The higher, the better. The holy grail of investing research, the price to earnings ratio. I bet almost all of you have heard of the PE ratio, because it's by far the most famous and most commonly used metric. It measures the current stock price to the EPS ratio and tells an investor whether a company is trading at a price that matches the earnings it makes. You want a low stock price, but high earnings, so the most value-oriented companies will have a low PE. However, there are exceptions to that rule, especially when it's a company that has a lot of potential but needs time before it can actually turn that potential into money. An example of that is Facebook, with a PE of around 100. Most of the PEs in the investing world are around 20, so you can see the discrepancy. Does that mean Facebook is way too overvalued? Not necessarily. Facebook has a lot of businesses that are mainly in the concept phase right now, like the Oculus Rift. Those aren't returning much profit, but they have incredible potential in the future. One job that investors have is looking at the PE and then checking for a situation similar to Facebook right now. Another famous variation of the PE ratio, the PEG. While the PE itself tells us a lot about the past performances of the stock, the growth aspect of it is added in with the PEG. Basically, it'll tell you the growth potential of a company given its current earnings. If you want the PE to be low, but growth to be high, look for PEs under 1.5. Moving away from the PE, price to sales tells you how much each dollar of revenue should be in correspondence with the current market capitalization of a company. You want the revenue to be high, so lower is sometimes better. The gross margin, another favorite of investors. This metric sees how much of a company's revenue is kept by the company after paying for production costs. As you'll see with most metrics, a higher gross margin means the company is keeping more of their revenue, which is good. The operating margin is similar to the gross margin, but instead of discounting the revenues for production costs, the operating margin sees how much revenue is kept after incurring operating costs, such as employee compensation, building maintenance, etc. Again, higher is better. The net income margin is basically a combination of the operating and gross margins. It sees how much of the revenue the company keeps overall. Higher is obviously better. Now we transition to the return ratios. We'll start with return on assets, or ROA. This ratio shows how profitable a company is based on the growth of assets. Assets are good, so more asset growth is awesome. Return on investment is very basic. It's just how much money you gained or would have gained if you were invested in the stock from a given time. Unless you have more than enough money to spare, you'd probably want this to be positive and high. Return on equity is essentially the same thing as return on assets or investments, but it looks at shareholder equity. The ROE shows how much the value of all the money that shareholders have given the company over time has grown. This is pretty self-explanatory, but if you're giving money to a company, you'd probably want the company to make that money grow, so the ROE better be high. Now you've probably noticed that I keep saying higher is better. However, I've never answered the question of what it should be higher than. There's no benchmark value for these metrics, so it's entirely based on your own intuition. But don't worry, I'll give you a solution at the end of the video. For now, let's continue. The cash return on assets ratio tells an investor essentially how much cash is being made in comparison to the number of assets a company has. You can use this metric to compare business performance to others in the industry, which, by the way, is key to the question that I just asked about comparisons. Dividends. We didn't really go into what a dividend exactly is, so I'll take this moment to explain them. They're quite simple, actually. See, when a company takes profits from its sales, it recycles a lot of that money back into the business to grow more. However, sometimes, the best businesses still have some money left after reinvesting and compensating, so it'll pay this extra money out in a process called dividends. Essentially, every share will receive an extra, say, 50 cents for being a shareholder. It's kind of a nice little gift from well-run companies to their shareholders. So the dividend payout ratio tells you what percentage of the total profit is the company putting into dividends. You want to see a company put a lot of money into dividends, so higher is better. Operating cash flow is a crucially important metric. You can find cash flow information in the consolidated balance sheets on a 10K or 10Q report, or online. Cash flows are pretty easy to understand, as it's just the difference in the amount of money flowing into the business and flowing out. You always, 99.99% of the time, want to see a positive, large cash flow, because that means more money is flowing in while less is flowing out. For our final profitability ratio, we will look at the EBITDA. The whole reason why the EBITDA was created was because companies have a habit of slightly manipulating their financial figures to look better. They do these weird things like depreciation and amortization that are technically legal but aren't entirely accurate. So the EBITDA, standing for earnings before interest, tax, depreciation, and amortization, tells an investor the actual figure of how much money the company made. Notice, you'll never find the EBITDA listed explicitly on a balance sheet, and it's not exactly easy to find figures for depreciation, so companies definitely are not big fans of the EBITDA. Now, to efficiency ratios. The inventory turnover ratio tells an investor how efficient and successful a company is at turning inventory into sales. You want high sales for low inventory, so the best companies have high inventory turnover ratios. Receivables turnover is the same as the inventory turnover, except instead of inventory, the receivables turnover ratio looks at accounts receivable. We covered them in the previous video, but as a recap, they're just accounts of rain check purchases by end customers. Again, you want high sales and low receivables, so high receivable turnover ratios. I know you must be getting overwhelmed with all this, but don't worry, we're almost there. The asset turnover ratio shows how much revenue is generated per dollar of assets. Essentially, it tells you how well a company is using their assets to make a profit. High asset turnover ratios, please. Working capital is another important metric. Companies are often bombarded with random expenses and bills all the time, so it's important as an investor to know that the company can handle those types of small expenditures. The working capital ratio tells you whether or not a company has enough short-term current assets to cover any short-term expenses. Next, asset efficiency. It's really similar to the asset turnover ratio because it also measures how a company uses its assets to make money. This time, however, the asset efficiency ratio uses cash flow instead of revenue in the formula. External financing index isn't a very widely used formula, but I believe that it provides a lot of insight into the inner workings of a company. It shows an investor how dependent a company is on financing versus the regular business of, say, selling a product. Naturally, you would want the company to make money from products instead of volatile financials, so look for lower external financing. Now, the leverage and debt ratios. These are quite important when looking at how much debt a company has and the reason for that. The debt to asset ratio compares the total assets of a company to the amount of long and short-term debt. If this is too high, then there's too much debt and might not be the best investment. Debt to equity is essentially the same thing, except it shows how much shareholder money has been invested in debt leveraging. Often, companies will purchase debt in attempts to grow, and strangely enough, it works out a lot of the time. However, it's quite risky for both the company and the investors. Low debt means the company is solvent and will not be weighed down during recessions. The all-important debt ratio compares total liabilities to total assets, and it's basically a combination of the debt to asset ratio and the debt to equity ratio. You want less liabilities and more assets, so look for low debt ratios. Interest coverage is a metric that looks more specifically into a company's debt, and it shows whether or not a company can afford an expense on that debt. The EBIT is similar to the EBITDA, except without the depreciation and amortization. You want the EBIT, or free cash, to be more than any potential interest expenses, so the higher it is, the better. The capitalization ratio is another leverage ratio that shows how much debt exactly is being used to grow the company in terms of market cap. It's calculated through long-term debt, which ideally should be low, so the overall ratio is better than when it's lower. Last three, folks. The current liability coverage ratio shows how many cash flows can completely cover the current liabilities in the case of an emergency. Cash is king, so higher current liability coverage ratios are better than lower. Long-term debt coverage ratio is identical to the current liability coverage ratio, except measures long-term debt instead of current liabilities. And finally, the last metric of this video, the cash flow to debt ratio. It shows how many cash flows would be required in order to completely pay off all the debt in the company. It should be high. Wow, that was a mouthful. If your head is spinning, sorry, but it's not nearly as difficult as it seems. All of these metrics are there to help you, as an investor, to make more informed decisions about a company. With your reference sheet, you can find out exactly what those ratios are for a certain company. Then, you can use them to compare your findings with other companies in the same industry to get an idea of whether a metric is higher or lower than others. That's the answer to the question about comparisons. It might seem like a bunch of work, but trust me, doing this type of research doesn't take much time. The benefit is that the research will provide a much deeper view into a company than ever before. We'll get into analyzing these metrics and actually using them to make decisions in a later unit, but for now, just live with these formulas. I know this was quite a long video, but it was incredibly important. I hope that this video was helpful for you and that you took some notes or made a reference sheet with all these formulas. If you didn't, then I advise you to rewatch the video and do so. Anyways, thank you all for watching, and I'll see you in the next video, where I'll show you how to decipher CNBC and the various economic papers that you find in your everyday life. Thanks for watching, and keep making money.